Hey, and welcome back to another episode of the Friday Five. We're closing some loans today, working from home. Then the thunderstorm came, so I never made it to the office. So here I am on my deck shooting the video. No fancy microphone, no fancy headphones, just me, nature, and an iPhone. Jumping into mortgage rates. So again, national averages from Mortgage News Daily, like we always do. VA 30-year fixed, 6.37%. FHA 30-year fixed, 6.35%. Conventional 30-year fixed, 6.92%. Conventional 15-year fixed, 6.26%. And then that conventional 7-year ARM, 6.45%. So rates still struggling a little bit with tariffs and what's going to happen, unknown from that. The inflation numbers have been better, but they haven't been moving the market much. So we're still under 7% for most customers, but there certainly are some that don't have perfect credit that are getting rates over 7%. So we'll hope that the data falls our way and maybe some of the tariff talk settles down, as I've been saying for weeks, and hopefully we see some better rates at some point. All right, number two, I want to issue another warning on student loans. So again, this week, I had another customer who we had a soft pull on a pre-approval, and she said, my scores just dropped a bunch. I can see it on my side, and it was related to student loans again. She had 4 different student loans. She was kind of ignoring them, just wasn't paying attention, and they all showed up as 90-day lates. So please, if you have student loans, if they were in deferment almost long enough that you forgot that they existed, please go in, log into your online account or call your student loan servicer and figure out if you have payments due and request income-based repayment or deferment or whatever you need to do. But don't just ignore your student loans because they are going to crush your credit scores if you do so. Number 3, we are having a little launch party for our branch coming up here in early June. So if you're a local business partner here in the Lehigh Valley or a housing industry professional, we would love to invite you to our party and our launch party. So reach out to me via email. You can email back, or if you have my cell phone number, you can text. I'm not just going to put a blanket invite up on a video that I'm shooting and posting all over YouTube and everywhere else on socials, but we would love to have you join us. We do need you to register so we know how much food to get. So if you're interested in joining us at that party, please reach out. All right, number 4. So over the past couple years, non-QM or non-qualified mortgages have gained quite a bit of acceptance in the market and a lot of momentum in different types of borrowers who maybe don't fit into that normal conventional Fannie Mae, Freddie Mac, or FHA or VA loan products. In 2024, 1 in 20 mortgages were non-QM, meaning they didn't fit into that normal traditional mortgage underwriting box. And in 2025, many are predicting that that percentage is going to go up again. So some of the most common non-QM products that we've seen or we're using with our customers, bank statement loan, where essentially the borrower is going to qualify if they're self-employed or a gig worker. They're going to qualify based on the deposits that go into their bank statement. Or another option is a 1099 loan. So if someone is a 1099 employee, we're going to use their 1099 to qualify less an expense ratio. And then the one that's probably the most common is the DSCR, the debt service coverage ratio, where essentially someone's buying an investment property. Instead of looking at the debt to income ratios based on the borrower's income and their monthly debt load, we're just kind of looking at that property alone. And we're looking at, okay, what would the rental income be from this subject property? And what is the monthly mortgage payment? So there are some really good options out there if you don't fit into the traditional box. Super important piece though, if you're interested in getting a non-QM loan, these aren't your crazy cousin Eddie's subprime loans from 2003 or 2004. You're going to need to have good credit scores. You're going to need to have a decent down payment. to qualify for these loans. So make sure you're paying attention to your credit. Make sure you're saving some money so you can put a decent chunk down if you're interested in non-QM. And the last item, number 5, thought of the week. So in listening to a podcast this past week with Arthur Brooks, who many of you, if you listen to podcasts, you're aware that he's kind of like this godfather of the research of happiness and what makes people happy. And he was talking about the difference between kind of contentment and complacency. And I think it's worth mentioning because I was listening while I was out on a run and I had to process it a little bit. So contentment is really a state of happiness, peace, and appreciation with one's situation. Whereas complacency implies more of a certain satisfaction that's kind of unaware of where you're at and whether there should be a desire or motivation to improve. It's just kind of like, I'm good. So I feel like a primary emotion in contentment is joy and gratitude, whereas the primary emotion in complacency is more ignorance with maybe a lack of desire or motivation. So by all means, be content with your life, appreciate what you have, but don't let yourself fall into complacency. Be content, not complacent. Thanks for watching. Have a great weekend. The sun's coming out. It's been raining all week, but hopefully you have a great weekend. Reach out if I can help you in any way. Thanks.